Ladies and gentlemen, the long-awaited interest rate cut has finally arrived, and yet the stock market has went down. What's going on? But more importantly, what's the outlook looking forward? All these I shall answer it in today's video. So Jerome Powell and the Federal Reserve has instituted a interest rate cut of 0.25%, and the market has reacted. I'll be frank with you, this is all expected and anticipated. So it isn't that big a surprise, but let's watch on and see what lies ahead. As usual, this video is for education and entertainment, not financial advice. Remember, hit subscribe and stay updated, for I foresee some big moves are happening in the financial market following this news. So let's take a snapshot of what happened yesterday night. There was an interest rate cut. The Federal Reserve cut the interest rate by 0.25%. All this already been anticipated, and that's the good part of it. But the words that are given by Jerome Powell during his speech actually give a lot of insights, and I'll cover them in a short while. But essentially, this is a risk management rate cut. That means that there are both now risks of inflation and risks of labor. I think the labor one is a little bit more risky, so let's cut the labor one. And there are no guarantees, but I think they're all leaning towards more good news that are coming. So Jerome Powell's strategy is what we call a measured move. So in the FOMC, the committee generally support a 0.25% cut. But one of the members have a proposal to go for a full 0.5% cut, which the committee broadly rejected. And that's including those people that are appointed by Donald Trump himself. Now, the large concern is right now a fight between inflationary possibilities and labor market slowing. So these two are exactly right now in conflict. And the truth is that the labor market is slowing down right now with increased unemployment. Now, it's also worth to note that inflation remains elevated. It has not gone down to the 2% that the Federal Reserve wanted it to be. And that's largely driven by a tariff impact. So the tariff policy is creating upward pressure on prices, and service inflation, especially housing and other wage-driven services, are also having a significant cost stickiness. So the Federal Reserve decided to adopt what they always do, which is a data-driven meeting-by-meeting decision-making. So we shall see the fight between inflation and unemployment and see which one comes on top of mind of the Federal Reserve. Now, this part is quite important. Donald Trump is non-stop trying to interfere in the Federal Reserve decision-making, and the chairman of the Federal Reserve, which is Jerome Powell, is sticking to his guns. Okay, he wants to maintain the independence of the Federal Reserve. So the Federal Reserve is guided only by dual mandate between maximum employment and price stability, and not guided by politics. So the decision making yesterday was really a risk management approach, not a panic response to the pressure of Donald Trump. And they only base their decision on economic data and nothing to do with politics. So during Q&A, there was a long Q&A. There were a lot of questions being asked, but essentially he was being asked, why is there only a 25% basis cut and not a 50 points basis cut? And Jerome Powell actually said that they have actually reserved some of these larger cuts for emergency, which they don't think right now is that state now, which is fair. I don't see it as an emergency. And he actually hinted that it is possible that future cut, but it's not promised, and they are guided by the dot plot. Now, there's this thing called Summary of Economic Projection, which is also called SEP. And in this SEP, the Federal Reserve FOMC members actually give a projection of where they think the interest rate should be, and they are guided by some of these as a food for thought, but it is not a commitment. So the labor market right now is in a weird situation. It is both supply having a constraint and also demand having constraint. So actually that will act on both different directions. So there is, number one, a reduced immigration flow because Donald Trump is now stopping a lot of immigrants from coming in and expelling many immigrants. Number two is they are also having a lower workforce participation. And this should drive up wages. But on the same time, okay, there are fewer jobs opening, right? Companies, because of artificial intelligence, because of weaker demand, they're not there to hire too many people. And as a result, there is a demand problem as well. So they act in opposite direction. So it's in what I call a curious balance, okay? And this is unprecedented. And we shall see what's the final outcome in time. Now, the analysts and the media have come together and give their comments. So Reuters say that this is a cautious but not aggressive move by the Federal Reserve. I think that's right. And Bloomberg says that the labor weakness is driving pivot now. That means the weaknesses that we're seeing in the labor market in US is causing this change right now. So it is a mixed reaction. Let me say this: the stock market did not go up, in fact, went down slightly. Is largely because this is already priced in. Everyone expected this thing to happen, which is the interest rate cut. So when it actually happened, don't be surprised that there's just profit taking and at least nothing surprising. So the analysts are split on the ease of interest rate as at how fast this interest rate are being cut. I think bonds wise, generally they are happy by the dovish stance that the Jerome Powell is taking. The equity traders seems to be less excited because they are hoping for something more concrete. And right now, there seems to be some kind of divergence between what the market is expecting Federal Reserve to do and what the Federal Reserve is signaling. But that said, market is always optimistic more could happen. Okay, let's go into details what the analysts are saying. Jeffrey, one of the analysts from Double Line Capital said that the Federal Reserve 25% basis cut is the right move. And he warns of aggressive easing risk will reignite inflation. I think so as well, because right now we're just in the beginning of the implementation of Donald Trump tariff. Maybe aggressive cut in interest rate might spark off inflation, which is something we hate. The Wall Street market has a mixed view as well. Number one, Morgan Stanley say that they do expect 4 straight 25% basis point cut, which is a full 1%. That's quite rare. Okay, that's quite rare. And Moody's said that there's about a 48% chance of a recession happening over the next 12 months. Wow, that's a very bold prediction to say that there could be a recession. And Evercore said that is a bullish, dovish, kind of cut, and they do expect there to be a further cut in October and December. So 3 rate cuts are predicted by Evercore. I also think that most of the case we're looking at 2 rate cut, but with a small hope that there could be a 3 rate cut. So we have got a balancing act that Federal Reserve needs to do. Right now, the inflation is still high, above the 2% target, which is now at 2.9%. And on the other hand, there is a 48% chance of a recession, right? So you cut the interest rate too fast, you get inflation. You leave the interest rate high, you get recession. So the Federal Reserve now face a very high bar to manage this tricky balance. So there are key tensions ahead. Right now, there are sticky inflation versus weak job. So this is a tension. Number 2 is that the Federal Reserve independence is now being challenged by Donald Trump. So there's political pressure on them, so whether they can remain independent. And there's hope by the market and there's caution by the Federal Reserve. These two pull each other aside. So I think this is where the dilemma is. So therefore, we are in a very, very unusual state of I'm not so sure. As it stands right now, the market, I think, look rosy. Jerome Powell has hinted 2 to 3 more rate cut this year. The bonds market continue to do well, and equities, I think with AI, with improved financial condition, I think that's good. Now, the reason why the market is not rushing up right now is because all these cuts are already priced in, and the initial reaction seems mild. But I think over the next few weeks, unless there's some black swan event, the market will still continue to go up. So the road ahead looks, in my opinion, my guess is looks very rosy and optimistic. I still think that the equities will continue to have a bull run that's AI driven, okay, largely AI driven. And this bull run will continue probably to the end of the year with a lot of volatility in between. And the bull run of the bonds market, okay, has just ignited. And many of you already made some money, but I think you'll continue some more. If we're looking at 3 rate cut, then the bonds will go up even more. But all these have a cloud of uncertainty and volatility, because we're not too sure what the Supreme Court will deem as legal or not legal for the tariffs. And trade negotiations are still happening, largely because China and US haven't come to a landing yet. So all these things could cause things to go really up and down, left and right. So I think diversification is still the mode to go. For those people who make money, I still feel that some profits should be reallocated to some other assets. But that's just me, okay? Just be safe. I'm a very conservative investor. So I think I would choose to do paths like this. And don't forget, you have a wonderful CPF, which we all aim to top up. So thank you for watching. I hope that this will give you an insight of what happened in the interest rate. I think the outlook still look very rosy, but I'll see you tonight, okay? And let's do a live stream together. Bye-bye.